Hello, everyone. Welcome to Retire with Style. I'm Alex, and I'm here with my trusted companion, Wade Fowl. And in this episode, we'll do a best impersonation of radio call-in hosts as we do our Q&A sessions. Right, Wade?
That's right. And this is a matter of over the summer, we had quite a few Q&A episodes, and we had a long backlog of questions we hadn't gotten to. So we're playing catch up, and we're trying to work our way through the backlog of questions that came in to make sure we get everything addressed.
No, 100%. And for those of you, just keep on sending them. We will get to them, and they're great for like content ideas for us. So even though we may not hit the question immediately, we keep abreast of it because we do try to keep a pulse of what folks are asking, because it just behooves us for our sister firm, McLean Asset Management, our online membership site, Retirement Researcher, and then it helps us with just the content and research that we're always looking into.
Yeah, that's right. We may not answer the question today. We may not answer the question tomorrow, but someday and for the rest of your life, we will.
That sounds like what you tell somebody, Wade, when if your wife asks you, "Hey, Wade, it's recycling. Put it outside in the front." Are you like, "Yes, I'll get to it. I'll get to it."
That sounds like my kids.
Sounds like
if
me.
they don't do it immediately, they're never going to do it.
Oh, really?
Oh, they'll forget.
Well, hopefully you can be a good example with these questions. We're getting
we
to
haven't
them.
forgotten. We're just taking our sweet time with it.
All right, here we go. Let's kick it off with, I'll throw you a softball. You ready?
Okay.
I like your podcast, but I can't find a list of all the episodes. Is there a complete list of all the episodes available?
Mm-hmm. Yeah, we thought we'd start with that question. That's the only one that's meta, so to speak. But
Let me answer this way.
You can.
Actually, yes. Go to retirewithstyle.com. And that's the website for this podcast. And we're actually going to start really filling that up with a lot of cool stuff. But there we do have a list of all the episodes that you would ever want to listen to. All the news that's fit to speak.
And that may be new since the question was asked. But indeed, all past episodes are available at retirewithstyle.com.
And again, goes without saying, but you can subscribe to everywhere where they syndicate podcasts, such as, Spotify, the Apple one, et cetera, et cetera. We're everywhere, so you should be fine if you wanted to subscribe and get updates to it.
That's right. Okay.
All right. All right, so let's get to the meat of the sandwich immediately. that bread was wafer thin.
And the questions for this episode, we're putting them in themes so that it's not just completely random. We're doing more distributions from qualified accounts and Roth conversions is kind of the theme for this week.
Yeah, we're going to hover around those questions. All right, so the first one is a doozy, and we'll break it up into 4 parts as our... Not a surprise considering our readers and listeners. They really get down in the well served in the details, because that's where the devil is, right? And you need to get that out. So the first question is, I have in quotations, rule of 55 questions. I left employment of company A when I was 55 and understand I could withdraw from that 401k without penalty prior to 59 and a half under the IRS rule of 55. After a short period of unemployment, I began working with company B where I have a new 401k. I did not roll 401k money into A to B yet.
From A to B.
From A to B yet, because he doesn't like the options in B, nor have I actually withdrawn any money from A. So the questions. Today, while employed at B, can I still make penalty-free withdrawals from the company A 401k if I choose? If yes, oh, wait, never mind. Go ahead.
Yes. So, right. This is like exceptions to the early withdrawal penalty. And the concern is before you're age 59 and a half, if you take distributions from qualified accounts, you pay a 10% penalty unless there's an exception. And right now we're talking about the exception that only applies to an employer plan from a particular employer if you leave employment after age 55. It's not you left earlier and wait till you're 55. If you left employment after 55, then you can take penalty-free distributions from that plan, assuming they allow it. And that's an important caveat. The employer plans have the flexibility to decide whether they allow discretionary withdrawals or not. So assuming they allow it, you can distribute from that plan without penalty. And yes, that's true. It's okay if you go to work again somewhere else. There's no check about anything like that. You are still eligible. Even if you return to employment at company B, you are still eligible to make penalty-free distributions from your 401k that you had with employer A.
Okay, wait, and just something you said, I want to make sure it's understood. Okay, what if you retire at 53 and then, you're 55, you had said something. I just want to make sure that's understood.
Yeah, that's not you have to leave employment when you're 55 or older. You can't leave earlier and wait until you're 55. So that's an important part of the rule that I think people might overlook. You have to leave employment at 55 or higher to be eligible for this exception.
Okay. So the next question as a quadruple parter. If I leave B before 59 and a half, can I make penalty-free withdrawals from both A and B 401ks, assuming he's still contributing to the B?
Well, assuming you had, made contributions, right? You're pretty busy here because in this 4.5 year window, you left the company.
He's coming and going.
So there's probably not a lot in your account with B, but yes, there's no rule that you can only do it with one. So if both plans allow the distributions, you could take distributions from both plans without penalty, given that you're over 55 when you left.
So then
both.
It stands to reason, just because this is a little echo of the first question. If you're 57 working in company B, taking withdrawals from company A, you can also make contributions to company B.
Right. Yeah. And this question seems like it's more in theory in some way because if you're working again, why are you wanting to make distributions from company? But
I don't know. I'm just trying to think of all the scenarios that someone's listening could kind of come up with, and so just to close close any loops that could be open is the only reason I'm asking it.
Yeah, you're asking an extra question, but I don't think that's a problem. Like, I don't know that in practice you'd want to be taking distributions from company A and making contributions to company B, especially if you didn't like the options in company B. So.
I don't disagree. I'm just asking it in case somebody is like, on their elliptical thinking, hey, what about this? That's the only reason.
I think that's okay. That's almost like a harder way to do a rollover to company B.
Yeah. All right. Is there a limit to the number of 401ks one can make rule of 55 penalty-free 401k withdrawals on?
No, there's no limit. It probably just wasn't something people are really thinking about because this is all we're talking about in this 4.5 year window between 55 and 59. I guess if you're actively leaving employers and starting at another employer and leaving it and going to another employer, there's no limit on how many plans you could be taking distributions from. But again, in practical terms, you couldn't stay employed very long with these additional employers, so you probably don't have very large accounts or growth on those accounts, I would expect. Because once you're 59 and a half, all this goes away and you're allowed penalty-free distributions.
And if you meant it from previous 401k plans before 55, that wouldn't work.
Right. It's got to be you left the employment at each of these after 55. But in that case, you can have multiple plans that you're eligible to distribute from.
I think you would have more difficulty getting a referral from somebody to like if you left like 4 or 5 companies. No one's good luck with getting a good job referral.
Yeah, your resume is getting pretty busy there with this 4.5 year window we're talking about.
That's where the LinkedIn years are. There's these gaps or something. I walked the Camino in Spain for 2 years. All right. The fourth one. Does starting withdrawals at any particular time matter after all of your 55th year and separation of service?
Oh, and I think maybe that question is getting at So I left company A. I hadn't taken a distribution yet. And then I started at company B. At that point, can I still take distributions from company A? I think that's what the question's really getting at. And in that case, no, that's fine. You can. Returning to employment doesn't take away your right to take penalty-free distributions from your company A plan.
I don't have to. Yeah, I see what you're saying. I was thinking if they were asking about, like, is it okay to start withdrawals in general at 55, like, longevity-wise? But that I think you're right. It's more along the lines of what you were saying. Okay, and he ended it, Mark, with thanks for your responses and love your show. My wife and I both took the RISA and are total returns people. Good to
Great.
know.
Thank
Good
you,
to
Mark.
know. Good episode for this, since it's a lot of, withdrawals and stuff. All right, we good with that one?
Yeah, nailed it.
All right. Next question has a Roth conversion theme. And good for him. He's 35 and he's already thinking about this stuff. And this is from Kep 19901, cell block C.
Yeah, I think Kep's one of our regular commenters on YouTube, and this is not the first time we've had a question, so thank you.
Thanks, Kep. Really appreciate it. All right, I'm 35. TSP will allow Roth conversions in 2026. Is it smart to convert at least up to the standard deduction? Or wait until December 2026 to see my rough income for the year? Or do the conversions quarterly slowly? Or rip the Band-Aid off in January the 2nd, 2026 and deal with the tax hit? The money must come outside the TSP for conversion. Thanks, Docs.
Okay, yeah, and so given the
You may want
age
to
is
deal with these one at
35,
a time, right?
yeah, there's a lot to unpack here, but I'm assuming you're still working. Like, it's not a fire case where you're financially independent and retired early at 35. So if you're still working, it's what you're really dealing with here is probably more, should I make contributions to the tax deferred version of the plan or to the Roth version of the plan, more so than already thinking about Roth conversions. But that being said, it's always a matter of, you want to pay taxes at the lowest possible rate. Can you do that now? And if so, make Roth conversions. Or if you're able to take those distributions from the tax deferred account later at a lower rate, just wait until later. Now, in that regard, is it smart to convert to at least up to the standard deduction? Well, if you have no other income, you always want to fill your standard deduction with something. That's part of the whole tax planning. If you don't even have enough ordinary income to fill your standard deduction, you're wasting 0% tax bracket capacity. So you always want to be able to fill your standard deduction. But I think in this question, it's safe to assume there's other ordinary income that will fill the standard deduction for you. So you don't want to do a Roth conversion to fill the standard. You want to have your standard deduction filled somehow. But if it's already filled with other income sources, you're not specifically doing a Roth conversion to fill the standard deduction. It's already been filled. And then beyond that, generally, yeah, we do look at later in the year for Roth conversions, because you really do want to get a sense of what your tax picture looks like for the year. You're not jumping on January 2nd and making the Roth conversion. It's more at the end of the year, you want to look at, like, we have our tax map calculator at the Retirement Researcher Academy. You want to look at your income situation for the year and see whether you have some capacity to do Roth conversions at an effective marginal tax rate that looks reasonable to you. And that's really something you can only consider at the end of the year, especially if you're going to be hitting into the preferential income stacking issue. You have to know what your qualified dividends and long-term capital gains distributions for the year are going to be before you know what level of ordinary income is going to start pushing your preferential income from 0% to 15%. And then that may be the constraint. You do enough Roth conversion to get you up to where you still have your long-term gains and qualified dividends taxed at 0%. And that's where you stop. The $1 more, they're starting to be taxed at 15%. So yeah, the answer is wait till later in the year to get a full income picture and then consider whether you can convert at reasonable tax rates. That would definitely mean making sure your standard deduction is filled. But if you have other income to do that, you don't also do a Roth conversion in the amount of the standard deduction. That wouldn't automatically follow.
Good answer, Wayne.
Thank
Congrats. No, good. This next question is from JJ Wardle, also Roth conversion theme. Gentlemen, thanks for this show. It's excellent. I had to throw that in there, Wade. I had simple question for the podcast related to Roth conversions. I never really hear anyone address this question specifically. We are retired, in parentheses, me, age 66, and my wife, age 63. We have not started collecting Social Security yet, but we do have pensions and other taxable income that has us in the bottom of the 22% bracket. Even with estimated future RMDs, we will likely remain in the 22% bracket. Considering that our tax bracket will likely not change once RMDs start, is it worth doing Roth conversions now, considering there isn't a large or any tax benefit? Can you maybe consider... Yeah, okay. Covering this on the podcast? Yes, and we will. I'll answer that question. Wait.
Okay. Yeah. Well, you want to consider Roth conversions if you're going to get a tax benefit from it. So if simply you're not going to get a tax benefit from it, there's really no particular reason to do it. And indeed, so pointing out, we're pretty much in the 22% bracket today. And we think even with RMDs in the future that may push us to realize income we don't want. Well, nonetheless, they won't be so large that they'll push us out of the 22% bracket. And to be clear, even if they did, the next bracket is 24%. And that's a big bracket. I mean, a lot of capacity at 24%. So even if you got pushed a little bit over the edge to 24% instead of 22%, it's not that big a deal.
For our listening audience, what do you mean by that's a big bracket?
It's large. I mean, you can have I don't have the table. Well, I do have.
Well, the income, it pertains to the income spread is what you're saying.
The spread of income. So the 20.
You don't need to know exactly. I just wanted them to think, because they may be thinking 22 to 24 is just 2 percentage points. What are you talking about? But it's really, you have a lot more income to play with within the 24% bracket.
Right. So in 2026, next year, for married filing jointly, the 22% bracket is taxable income from $100,800 to $211,400. So that's not so. I mean, it's more than $100,000, but the 24% bracket,
a good number.
It lasts for about $200,000, from $211,400 to $403,550.
And since we're on this, since I heard you, this relates to the previous answer a little bit. You had said you want to fill up the deductions. You want to just talk about that dynamic very briefly so they understand what you mean by that when you were referencing your deductions?
Well, your below the line deduction is effectively a tax bracket too, although it's not shown on the tax tables that way. And
exactly.
You pay 0%. It's a 0% tax bracket. So if I don't fill up my standard deduction, I'm missing a chance to pay taxes at 0%. And the whole conversation is we know we have to pay taxes at some point. We look for opportunities to do it at the lowest possible rates. So if we're missing the opportunity to pay taxes at a 0% rate, it's not particularly efficient.
Yeah, you should front load as much as you can into that bracket.
Yeah, you always
maybe you have conversion opportunities.
Mm-hmm. Now, if you have other income sources that fill your below the line deduction, then that's kind of with the previous question. There's nothing else you can do. But if you don't have other income sources, you don't want to leave that standard deduction empty. And especially if you're 65 and older now with this temporary age 65 bonus deduction that we have through 2028. But yeah, the whole issue here, if you're in the 22% bracket already, it means you've already passed two of the big hurdles out there with tax nonlinearities. Well, if you had claimed Social Security, and someday you will, but you haven't yet, you're already out of the tax torpedo for Social Security, at least for the most part, unless your benefit's really big. And you've also passed the preferential income stacking issue because that happens entirely in the 12% bracket. So once you get to the 22% bracket, you're past two of the biggest hurdles. Now, the Affordable Care Act, if you're getting insurance through the Affordable Care Act, that would probably put brakes on any Roth conversions. And then beyond that, we're now through 2028, we have this age 65 plus bonus deduction. For this couple, one of them is over 65, so that would be a $6,000 bonus deduction. And in the 22% bracket, you're in the phase-out range for that. So right now, your effective marginal rate from that would be, I think, 24.64%. So that would push you against doing a Roth conversion, because right now you're paying a higher tax rate. Whereas in 2029 and later, unless they renew the extension to keep that extra deduction, you'll be back down to a pure 22% bracket. There's IRMA surcharges to deal with along the path up there with where you are in the 22% bracket. The net investment income tax kicks in at $250,000. And then well beyond that, you run into the SALT phase out that we now have temporary, that we talked about with Brett a few episodes back.
Yeah.
That doesn't begin until $500,000. So that's well beyond the 22% bracket. So yeah, all that together, if RMDs are not going to be pushing you into higher tax brackets, probably the balance of indications without really just sitting down and making sure to double check all the numbers. But yeah, probably there's not a particular need to do Roth conversions now at 22% to avoid future RMDs at 22%.
Something I like to point out, Wade, and this is from our crack marketing team. They say we don't talk about the resources that we have sometimes in the manner that we could. And as you can gather from the answers that Wade is giving, a lot of the decisions to convert now versus later has to do with bracket management and what your expected income is going to be this year versus maybe a future year, where it may be better to do it in the future, a conversion, as opposed to now, or vice versa. And you had mentioned the tax maps. Can you discuss what we're actually, have just released on Retirement Researcher and what you have planned for the tax maps? Because I fear people are listening to you, but they're also, even though you're saying if this happens and this, if that, then this, if this and that, but all those require sound calculations into your expected tax rates for the year. And what have we created on Retirement Researcher to help individuals, muddle through that a little bit better?
Mm-hmm. Yeah, we have the tax map calculator, and we just released a big update for it in November, including all the new provisions in the tax code with the new deductions that phase out with income, and things got a lot more complicated. But yeah, it lets you, and that's where at the end of the year, it's the best time to do this. It lets you input all your different income sources for the year. It lets you put in a target for the effective marginal rate you're willing to manage for ordinary income and also for preferential income. We show you both, whether it's Roth conversions or harvesting long-term capital gains. It'll show you your capacity to do that still at a particular tax rate target and give you guidance about what you want to do. And so what it would show in this case, if you're in the 22% bracket right now, you are dealing with one person age 66. You are dealing with the phase out of $6,000 of additional below the line deduction. Oh yeah, since it's just one, it wouldn't push you to 24.64. It'd push you to half, like 23.3 something % as an effective marginal rate. It would be 22 times 1.06. That would be your effective marginal rate right now. That's where, if that phase out ends in 2029 and later, you're back down to a 22% bracket. And then it's just really in that range, IRMA, and potentially getting close to the net investment income tax kicking in. And the tax map calculator we have would show you visually all of that.
And this is available at retirementresearcher.com. It's a membership site where we have tons of tools and cheat sheets and things along those lines. So I encourage everyone to check it out if this is something that you've been thinking about from the standpoint of Roth conversions, but also beyond just general financial planning. It's a curated site where we have our content, workshops, etc. But we also have tools that I was just thinking about it based on these questions, like, well, how are they going to figure that out? And so we have plenty of tools there, retirementresearcher.com. Check it out.
Yeah, it's specifically the Retirement Researcher Academy.
Yeah. Okay. Then here we go. Let's move on to the next one. This talks about the 4% rule and qualified, non-qualified accounts. But before I answer the question, just for those of you listening, a qualified account is our parlance, and maybe it's too much of a jargon term, but it's so ingrained in our heads that we probably say it without even thinking about it. Qualified accounts are like tax-deferred and tax-free accounts. The Roth IRAs, 401ks, regular IRAs, etc. They're just called qualified accounts. Non-qualified accounts are accounts that you're going to have capital gains on.
Taxable brokerage accounts.
Yeah. So if you're listening, like the standard Schwab account, retail account, that joint account that you may have with your spouse or something like that. All right. So that being the case, I'll read the question. Research on withdrawal rates seem to favor that the accounts being utilized are qualified accounts. I don't get it. If I am trying to withdraw 401k before taxes, isn't it the same whether or not I am withdrawing from a qualified or non-qualified account? 401k before taxes is the same 401k regardless of the account type. So why the disclaimer?
40K. Yeah. So it's.
Oh, 40. Sorry. I missed the one. Oh, so he was actually putting numbers.
You were putting numbers.
I was thinking about 401ks, and so he actually meant 40,000. I want to do that one again since I messed it up.
It's just
sorry.
The point is, if you're taking $40,000 out of an account, why does it matter if it's qualified or not qualified? It's basically the question.
Yeah.
And we might have briefly addressed this in one of our episodes with Bill Bengen, but I couldn't remember for sure, and still had the question on the list. But yeah, the answer is the vast majority of the research on sustainable spending from investments, the whole safe withdrawal rate question, the 4% rule type research, ignores taxes. So it's like you don't pay taxes, or more specifically, you could say, well, if it's in a Roth, no problem. It's just you get tax-free distributions. If it's in a tax-deferred account, well, you pay taxes on the distribution. So your after-tax spending is just the $40,000 distributed less the taxes that you paid. The problem with the taxable accounts is you have ongoing taxes on interests and dividends and any realized capital gains if they're in mutual funds and things. And yeah, at a very technical sense, if you considered all those side taxes coming out of the account as part of your $40,000 distribution, that would be okay. But I don't think most people are thinking that way. The issue is all those ongoing taxes on account cash flow distributions are lowering the growth potential of the account. So the after-tax safe spending rate from a taxable brokerage account will be less than, not necessarily less than the after-tax dollars you have to spend from your tax-deferred account. But if $40,000 is a safe withdrawal rate from a tax-deferred account, and you just pay your taxes out of the $40,000, well, you can't. $40,000 is not really the safe withdrawal rate from a taxable brokerage account, because unless you're doing all this extra work to figure out the ongoing taxation on my interest and dividends and everything has to come out of that $40,000. It's going to be less because of the ongoing taxes, and that's why that caveat or disclaimer is out there.
Yeah, I would also say this, and correct me if I'm wrong, and I apologize. I was looking at, he wrote 40K, and in my head, my mind was completing it as 401K.
You're auto-correcting.
I was auto-correcting. What I would say, yeah, exactly. I hallucinated. What I would say too to that is 2 points. When you're doing research studies, it's damn near impossible to do it with taxes because of the many iterations that you would have. You wouldn't be able to really get a uniform thing across the board, because what state do you live in even, and what are you holding, and how is this tax versus that tax? So a simplifying assumption in research is not that we don't think no one is going to pay taxes, but it's a way to make everything even, assuming there are no taxes. And then the idea, because it will still theoretically answer the heart of the research question. And so what's left up to the individuals is just do their own mental calculation on the after-tax amount on that amount. Yeah, that's why it's done. Now, I say the last statement, Wade, unless I'm reading this wrong, 40K before taxes is the same 40K regardless of the account type. So why the disclaimer? I think point blank it's not the same because the government owns part of that 40K still in these different accounts in different degrees, and so there is some accommodation that needs to be made.
Yeah, and so I do look at this general type of question in the retirement planning guidebook before getting into the full tax chapter itself, but just in the chapter on safe withdrawal rates, I put in some simple parameters and show like if you had a Social Security benefit, and we'll just look at if you had $2 million in an investment account, and the 4% rule would work, if you had $2 million in a Roth IRA, you're still able to take out, well, $80,000 would be 4% of $2 million, no tax issue. If you had $2 million in a brokerage account, this is where you're having to deal with the ongoing taxes on interest and dividends. How much can you sustainably spend on an after-tax basis? The after-tax safe withdrawal rate I get is 3.74%. And then if you had $2 million in an IRA, well, now how much can you spend after paying taxes on those distributions too? The after-tax safe withdrawal rate I got was 3.43%. So 4% with a Roth, 3.74% with a taxable brokerage, and 3.43% with an IRA in terms of after-tax sustainable spending rates. And that's with a very stylized set of assumptions, to your point. All they had was a Social Security benefit and money in one kind of account.
No, imagine that where you have different allocations, then it's a different study. If you have different holdings within those allocations, it's a different study. It's impossible to do a uniform study from a research standpoint.
But tax planning, well, software, financial planning software, that's where the whole like safe withdrawal rate question in real life is kind of a side issue, because if you're running the financial plan in financial planning software, it'll be accounting for the taxes for you and looking at can you meet the distributions and pay the taxes and not run out of money, and that's how it's going to run the calculations.
Fair enough. Okay. This one's related. Go on. You're saying something.
Yeah, this is a question for you. So I'll do the last question for this episode. And my question is, what do those demographics... Oh, is there part of it missing?
Say it again?
Oh, I think it might have been referencing... So talking about general demographic and tax trends. People are getting older. The percentage of people over 65 is increasing relative to the working age population. There's a national debt. We may have to have higher taxes in the future to cover tax bills. So my question is, what do those demographic trends and tax trends mean to equities and interest rates over the next 20 to 30 years? How should a retiree position their income and investment strategy?
This is something that came up many moons ago too in our space. It comes up when usually it's driven by books. There's a book written. I think Harry Dent wrote a book about the. I'm confused with now Ken Dykewald, his Age Wave book, but Harry Dent wrote a book about the coming doom of an aging population, and there's been a couple of them in the last, like, let's say 15 years. In fact, I did a quick search, just how many books have there been in the last 20 or so, and there's at least 10 to 15 that I recognize the titles from. And effectively, they're sort of futurist, right? Where they begin to think of scenario analysis of, if this happens and this and so forth. And the bottom line that you see is, okay, it doesn't take a genius to figure out that, listen, there's a whole bunch of older people getting ready to, to retire or retiring, as evidenced by right now that, 10 to 15,000 people a day are retiring, on a daily basis. And so how do the markets accommodate for that? And, the subsequent knock on that happens. And what you see with these books ultimately is, okay, fine. The folks are getting older, and that's going to impact changing spending trends, consumers, and the like. And directionally, all of those are correct because it's just simple math, right? But what they do get, consistently wrong is the degree to which, the outcomes that they predict as a result manifest themselves. And they're wrong because aging is just a factor within what's going to happen. You still have technology. You still have just basic global politics in play. You have innovations, et cetera, et cetera. And what you see is that everyone knows this information of what's going to happen, and then people adjust prices accordingly. It's not like from one day to the next, everyone realizes, oh my goodness, everyone's getting older. I got to reshape my portfolio. This is stuff that is already known. Like, by the fact that I said I did a quick search and there were like 10 to 15 books on this in the last few years that were fairly popular, it stands to reason that this isn't coming as a surprise to anyone. And when things don't come as a surprise to anyone, it sort of gets factored in on a daily basis. Similar to PEs. When people say, oh, the PEs are rising, right? The PEs don't go from 10 to 35 in one day, right? They march upwards, they march down or whatever, but it's sort of systematically, and people adjust along the way. And so that's what you end up seeing. I mean, there were, out of those books, I don't want to name anyone because, they're doing their best trying to give a gauge, but most of them are wrong, flat out wrong in terms of the impact that that's going to have on the market, while they were right on the upcoming demographic trends. And how do I interpret that? Is just the market is as a prediction. It's a sort of ongoing sort of prediction machine with odds, and it's providing the odds on this manifesting or not. And, it doesn't have to make these bold predictions about the implications because it's, these prices are adjusting along the way. And so really, I wouldn't do anything. There is nothing to do because I think the timing, because then you're going to start playing into this market timing piece of it. I mean, you put all your money in memory care facilities, that kind of thing. No, I wouldn't do that because the market already knows this. The market's already pricing this in. And so the best thing you could do, especially for the next 20 to 30 years out, is just consistently diversify your portfolio across asset classes that have, expected rates of return, and do that in a manner that is diversified, that gives you the best risk per unit of return per unit of risk that you're taking. And that's not going to be different now versus 5 years from now versus 10 years from now. And it shouldn't be different from the standpoint of, hey, the 60-40 portfolio or whatever, the 60-40 portfolio that you have now, that's going to have to be effectively a 40-60 in 10 years to accommodate for such and such. I think that's a fool's errand that's gonna lead you astray. I think you consistently stay with what you're doing with the assumption that I know this is happening, but so does the market. And so that's how it's priced in right now.
Okay, great. Very good. And that's a wrap for this episode, but we're going to continue further Q&A. We're going to get caught up on everything that's come in. Now, we're not still going to get completely caught up on this round of episodes, but we're moving in that direction. So stay tuned and we'll have more Q&A episodes on Retire with Style. Catch you next time.
Thank you, everyone.